Hey everyone, thanks for joining today's video. In today's video, I'm going to talk about what happened with my stock portfolio over the last week, what happened in the market, going to talk about some stocks that I bought, some stocks that I sold here or transferred out of throughout the week, and then just talk about some market news as well. So I hope you guys enjoy this video here today. Just before diving into what happened outside in the macro economy, you can see here in the last week, my stock portfolio is down about $2,500 on the Canadian side. And then on the US side, I'm down over $1,700 US. So all in all, about $5,000 all in Canadian dollars at least. So pretty terrible week. You can see here it's been at least down and then flat throughout the week on the US side, whereas on the Canadian side, it continues to trail down throughout the week. If we look at the broader stock market here, you can see the TSX, so the Canadian Stock Exchange, down about 1.5 points this week, going over to the US. Big rebound today, actually, but the S&P was down also about 1.5 points. Looks like the S&P is up a bit today, which was somewhat offsetting the weak performance from earlier in the week. And if we look at the main reason why lots of my stocks went down this week, it's really this continued push on interest rates. So last week, the narrative was interest rates are going to be higher at this 5.5% range for longer. And that drove lots of my stocks that have high debt loads and just structurally higher CapEx spend over time with higher debt, like telecom companies, REITs, obviously, with their interest rate exposure, utility companies, etc. All those companies went down pretty dramatically. This week, that kind of just accelerated. Here's one of many headlines throughout the week. Jamie Dimon warns that the Fed could still raise interest rates sharply from here. So not only now is there rhetoric around interest rates staying higher for longer, they're starting to talk about interest rates that could go up to 7% in a period of stagflation and things like that. So it was really interesting to see how this has just escalated from last week, people being surprised that the interest rates at these levels would be the same in 2024. Now we're talking about going up from here with like a very respected banker like Jamie Dimon. So here's just a summary of that. Comments come less than a week after Fed officials indicated that they could approve another quarter point increase before the end. Before beginning to cut a few times in 2024. So this whole narrative of interest rates going up from here have not been good for the stocks, and we'll see that in a couple of minutes as we go through my portfolio. Before going in my portfolio, another thing I wanted to call out at the beginning is Northwest Healthcare Properties REIT. So this is a Canadian REIT. I do own them in my portfolio, and it's just been an absolute nightmare. They keep going down and down. They've had a lot of issues with the company, and they just released this special report last Friday talking about some of the things they're going to be doing to kind of restructure the REIT and whatnot. Overall, for most investors, the thing that mattered the most was their comments on the changes to the monthly distribution. So they went from paying out about 6.7 cents a month, which equated to, I think, 80 cents a year, down to 3 cents a month, so 36 cents a year instead. So obviously huge cut, like a 60% cut to the dividend. I expected it based off of the last few quarters and where funds from operations was flowing through for next year and where interest rates have gone. But obviously still disappointing anytime any of your companies reduce the dividend at all, let alone 60%. So obviously when I went and got into the stock years and years ago, at that time, I felt like the dividend was safe, or else I wouldn't have bought it. So this is definitely, a disappointing blow. But with that being said, looking at everything going on in the company and where their cash flows and funds from operations are expected to kind of fly over the next year, I think this move makes sense. Gives them more money to deal with their debt situation. Gives them more money to get through this situation of higher interest rates, some joint venture issues, etc. And then hopefully on the other side, they'll be able to start increasing this back up. And at that point, start accelerating their growth and funds from operations that they can share with shareholders from there. Okay, so what were some of the big moves that I made this week in my trading account here, or my investing account rather? one of the big moves I made, it was a big dollar amount move, not a big strategy change though, was moving my entire cash position into a cash maximizer ETF. So I actually initially got tipped off of this ETF from a viewer who left a comment just about the tax implications of holding CASH cash in a unregistered account, and that this may be an option I may want to look at. I did my homework, did some research on it. I actually posted a video earlier this week on different options to execute on in order to make sure your cash position was generating some cash flow for you, or cash flow or return, whatever you're looking for. And I actually talked about some of the research and some of the learnings from this ETF. But essentially, the biggest benefit here is instead of an ETF like cash, which I'll type in here, cash accrues interest throughout the month and pays it out to you in a dividend. At the amount of money that I had in cash, I was making probably about $1,000, if not a tiny bit over $1,000 a year on an annualized basis in dividend income. And on that $1,000, I was probably having to pay almost half of it back to the government in taxes, since it's not even eligible dividends, it's distributions. So if I was holding this in a TFSA or an RSP, I wouldn't really be as concerned at all. But the fact that at the end of the day, after the tax, I'm pretty much getting closer to a 2.5% to 3% return on my money. Whereas on this ETF here that I just moved into, with the amount I'm into it of about $17,000, that money should just be coming from capital appreciation over time. So you can kind of see here, instead of paying out the dividend every month with the high interest income that was accrued, they just reinvest it into the company and into the ETF. So while this makes for an asset that may not be 100% as predictable in terms of actually getting the money out on a monthly basis for your high interest, over time it's shown the track record that it does go up in line with the same return, more or less, as you would get with the cash dividend paying ETF. So I thought to save and defer the taxes, since it was such a large position for me and one that may actually grow as I continue to build cash and interest rates continue or possibly go up, according to Jamie Dimon, I thought this was a prudent move to make. So that was my biggest dollar amount move I made over the last week, over $17,000 moved. But I would say it was no strategy or objective change. It was really just trying to be as smart as possible on taxes and how I hold the positions that I want to hold in my account. In terms of some other stocks that I bought in my Canadian account, I did go dumpster diving a bit with Allied Properties. Allied Properties is a stock that I've owned in this account for a while now. You can see my overall return here is about minus 32%, down $2,000 in this one. In my opinion, over the last week here, down another 7% after in the last month being down another 13%. I thought it was in a really good risk reward territory to buy some more stock. So I actually went from, I think, around 200 shares. Now I'm up to 226 shares. I think I bought 20 shares in the past week, so about $400, give or take. The company is still expected to do about $2.20 of funds from operation, making them at about an 8.5 times earnings multiple. They also pay out a $1.80 dividend a year right now. They've been increasing that dividend, believe it or not, year over year. So even if they don't increase that dividend and it holds flat, that would be about a 10% dividend yield on this company that you're buying at right now. And it's a bit ironic to be talking about double-digit dividend yields in the same video as flagging Northwest's big dividend cut. But unlike Northwest, Allied hasn't really seen too much volatility in their funds from operations yet. I don't know if higher interest rates, potentially higher vacancy issues at their properties may lead to that, but just sequentially quarter over quarter, they continue to glide path towards that $2.20 of funds from operation for this year. Looking at the company a bit here, you can kind of see on top of the net asset value per share, you can see the dividend growth that they've had. So since 2013, they've increased the dividend every single year for a decade, even as they were going through lots of this turmoil with their stock price last year. They increased the dividend 175 to 180, so about a 3% increase. We'll see what they do this year. They usually do it in January. So maybe given everything going on, they may hold on to the extra capital and not increase it this year, which is fine. $1.80 dividend payout on an $18 stock price is more than enough. The other thing I'd like to call out is just the net asset value that you can see they've grown pretty much year over year, definitely on a 2-year stacked period over period. And they're at about $50 here. So trading at $50 a share for a stock price that is currently at 18. So not only are they undervalued, but they're trading at about 25 to 30% of their value in terms of the net asset value of the properties they own. There is no way that you can go into the public market or private markets and buy flagship office real estate for 75% cheaper than you could in 2019. So I do truly believe that it's been a bit of an overcorrection in general in the REIT space. And while office is the most risky and probably has realized the most real life impact, their impact or their changes in valuation in the REIT space has been the most overcorrected. And I think as long as Allied can get out of this, get their refinancing, keep tenancy or tenant rates, occupancy rates in reasonable places, I think they can definitely prove to have a way higher net present value than $18 a share. So a more risky one, but that's just my overall thoughts on why I went into this one a bit more this week. These are just some of the assets that they own here, because when lots of people hear office real estate, they're thinking these like rural suburban cities. This company here owns some of the biggest and some of the most luxurious office real estate in the country. This is right in downtown Toronto, Adelaide and Duncan. For those of you who may be familiar with Toronto, I'll kind of zoom out of it so you can see the intersections as well here. But they own a lot of really great real estate. They also have some exposure, about 10% of the business is retail at the bottom of their offices in some sense. And the offices they have downtown Toronto and whatnot, it's really prime retail of real estate worth a lot of money. They also own some parking lots as well. So they're a bit diversified, but don't get it twisted. You're definitely still buying a office REIT here when you're acquiring shares of Allied Properties. So this is a strict valuation play for me. I just think it's gotten a bit over corrected at these levels. The second stock that I have bought this week in my account here is some more CN Rail stock. So CN Rail, I think I bought 2 or 3 more shares. It was dipping over the last month down about 4%, jumping all over the place, but I think I got into this one around $147 here. So CN Rail across my accounts is actually my largest position, and I always like to nibble on it every year, mostly every quarter, just to make sure I'm continuing to build it up. I think it's probably, from a risk-reward standpoint, one of the best long-term plays in the Canadian markets. It's just so hard to imagine them getting knocked off in any big way, just given their physical presence across the country, the moat they have in terms of no one else building tracks and whatnot. So I think they are a great long-term company, and they usually trade at a pretty decent valuation because of that. So whenever they do get these 5, 6, 7% dips, I tend to like buying into the stock a bit more. They're paying over a 2% starting dividend yield. They're trading under around a 19 times trailing PE, and they're finally back under the $100 billion market cap. So on this one, I decided just to nibble in with a few extra shares. I shared a video in the 4 stocks I'm buying this month. I went into a bit more depth in CN Rail. If you're interested in that, you can see it on my channel for October 2023. But this is one of the great signs, or a great indicator in any dividend-paying company and company with a wide moat. You can see they've bought back about 10% of the a third of the entire company, from 950 million shares down to 660 million shares over the last 10 years or so. And that's really even ramped up more in the last few years. They took a bit of a pause, a bit more conservative during the pandemic. But this just shows that this company is making tons of free cash flow. I think they make $4 to $5 billion of free cash flow a year typically. And companies like this, for the most part, don't have 100 different growth opportunities. Yes, they're investing in their ports on the west side of the continent, and some other strategic opportunities. They sometimes look at small tuck-in mergers and acquisitions. They tried to buy Kansas City Southern, but that didn't work out for regulatory purposes, which also speaks to the monopoly that this company has kind of built. So they end up returning lots of capital to shareholders through share buybacks, which you're seeing here year over year over year, really sustainably, and just like lockstep. And then they also disproportionately increase the dividend more so per share than the amount of shares they buy back. So more absolute dollars going out to shareholders for dividends each year and less absolute shares every year kind of creates this really powerful compounding effect on the company. Talking about the dividend, you can kind of see here how fast they've been able to grow it. So even if I go to 2010 here, 2010 they were paying 13 cents a share. They're paying all the way up to 80 cents a share now, and this will probably go up closer to 85 cents. I'm speculating now. In January, the quarter that they tend to increase it every year. If not, it's going to be over 80 cents for sure, as they've increased their dividend every single year since going public in the mid-90s. You can see over the last 3 years, their average dividend CAGR is about 10%, which is really solid for a company that you're getting a starting yield over 2% on. So you're still getting some money now. You don't have to wait completely 3, 4, 5 years out to be getting a respectable yield on cost. The next Canadian dividend stock I was buying this week was Jameson Wellness. So I won't go into this one in too much depth because I've been because I've been talking about it a lot as I've been building it up week over week in these videos. But you can see here I got up to 80 shares in this one. Similar to prior weeks, it trended down a bit this week. So lots of it's today, but down another 2.8% on the week. Just super simple. Currently yielding almost 3%, trading at $1 billion valuation. Does about $80 to $90 million of free cash flow. Going to do about $1.60 in EPS this year. So at these ranges, trading around 16 to 16.5 times earnings, which I think is cheap for a company that plays in this space, has some level of global exposure with their acquisition in the US, their growth rate in China right now. So I think there's a lot of excitement around this company for future growth, but the market's pricing it as if it's reasons to be discounted versus other consumer products goods companies, which I don't see. So I think this one, really solid company, would be happy to build it into a much bigger position for the long term. Obviously not completely there with only 80 shares, but if it continues to be around the $24, $25 mark, I will definitely continue building this up week over week. So you'll hear more about this one. If it goes down more into $23, $22, I'll keep building it probably at a faster pace even. So that's another one I was buying this week here. Going over into the US side. So on the US side, I also made a handful of buys throughout the week. The first one that I was buying here, I bought a few Coca-Cola shares. Coca-Cola now up to 182 shares. In the last week here, you can see down another 3%. I don't need to vouch for Coca-Cola in terms of being a good long-term company to be in. They've kind of done that themselves over their history. So I'm just continuing to average in. My average price is around $60 a share, I think. Yeah, right at 60. So as the company goes down in value, I still think no matter what really happens in the economy, Coca-Cola will still be in a strong position. They still have really great global diversification, great brands, continuing to expand in all areas of beverage. Right now they're pushing in coffee, pushing in alcohol even to some degree. So I think they'll continue to make good progress there, and really good business. Not a category that's overly elastic if you think about the absolute purchase price of a soda or water or whatnot. And in lots of areas of the world, Coca-Cola is really responsible for lots of the drinking water and just beverages that an entire community, entire cities take part in, just given the state of what their drinking water may be like and whatnot. So really high mode on this company, really great business, great brands. I think it's, historically speaking, at a fair valuation here, and I'm getting a starting yield of 3.3% on a company that increases their dividend every single year, over 60 years now. The other company that I bought this week, more of realty income. So along with all of the other REITs, On the Canadian side, realty income also continues to get smashed here. You can see down 16% in the last 3 months. I think realty income, just as a company at large, is a great business, great company, one of the best REITs probably available for purchase in the world with their track record, their diversification, their triple net lease statuses on all of their properties. So to see it go down 16% here in the last 3 months, I get it. It's just a math equation with interest rates going up, opportunity costs going up. But I think in the long run, realty income will be the underlying assets will be great assets to own. So having a long-term investment horizon, I'm actually looking this as a great opportunity to build a meaningful position in this company. Currently at 175 shares. I think I added 5 more shares this week on the weakness, now officially yielding over 6%. You can see here they actually increased their dividend last month by about 0.5%, but they continually increase their dividend almost on a quarterly basis. They've paid their dividend month over month for hundreds and hundreds and hundreds of months. They call themselves the monthly dividend paying company. So I think it would take a lot for them to not pay a dividend or cut their dividend given their track record. They seem to have a model that makes sense in terms of how they invest, where they invest, how they deal with their debt, how they reinvest profits, how they drive scale for synergies across the business. It's just really worked for them over the long term. So excited to be getting in at a relatively low valuation here, historically speaking. Funds from operation, it's going to be about 4 this year, so I'm getting them at about 12.5 times funds from operation here for a really strong diversified REIT in the triple net space. And then the last stock that I was buying heavily this week, before getting into it, one ETF I was actually adding to a bit this week was the Vanguard Total International Stock ETF. Same as the last few weeks that I've been talking about, slowly building this one into a bigger position. Going to try getting this one up to 50 next week. It's always nice buying it when it's down. So averaged in this week about 10 more shares on some of the weakness in the broader markets here. So that was nice to be able to do on this one. And then the last stock that I added to this week was S&P Global. So now currently at 8 shares on S&P. I think I had 6 shares last week. Still down as this stock got hit pretty hard with some of the financial news and some financial sentiment. Interest rates going up impacts the amount of debt that companies are looking to release and raise from investors. And with that, that impacts their credit business because it's less debt to grade. So that was one impact here for S&P Global that investors kind of put 2 and 2 together that may impact their growth rate on their credit business, which is a big part of the business. The other thing is they rely for assets under management essentially for their index business, which is only about 10% of the business. But as the S&P goes down, as the Dow goes down, as all these other funds that they own and manage go down, their assets under management as an absolute amount also goes down with it. So those small things have, month to month, quarter to quarter impacts. With that being said, over the long term, debt's not going away. If not, debt's going to be going up over time in the financial markets. The overall markets, if you look at the track record, the S&P Global, the Dow, will likely continue going up over the long term. So all these things that have dragged the price a few percent over the last month or so, as you can see here, are all things that I feel really comfortable will fundamentally be tailwinds, not headwinds over the long run. So bought a few more shares. Hopefully it gets closer to, hopefully the stock continues to drift down a bit since it's still not a big position. And I can get in at least 10 shares as a nice starting position on this one, paying about a 1% dividend yield. I think their forward PE here is about 28 times. And market cap, big company still, $117 billion on this guy. So that's just some of the activity that happened in the market this week. If I was to just look at some other stocks that piqued my interest that or at least had big moves, Visa here down now to $230 a share for the first time in a while. If I just go back the last 3 months, we're pretty much at 3 months lows. So this is one that I'm interested in potentially evaluating or looking at building my position there. Visa's a great company. One of my favorite stocks, just always trades at a pretty rich valuation. We saw P&G and some of the other consumer companies drop a bit. So P&G down about 5% here on the week, just with some of the broader weakness for the consumer being projected out and whatnot. Going over to the Canadian side here, you saw real estate go down, but what kind of surprised me a bit was to see royalty funds go down too. So A&W royalty has already been hit this year. I've been building a position on the weakness, down 12% in the last 3 months alone, down another 3% this week, which was really interesting to me. You know, like these royalty funds don't have any debt, so that operationally doesn't impact them. Depending on what ones you buy, they actually are somewhat recession proof. Like I believe A&W in a recession will hold up just fine, because for people that are trading down to not eating takeout, there's going to be a whole bunch of people trading down from going out to sit down restaurants into takeout. So the only thing I can think about as to why the interest rate sentiment and recession sentiment has any impact, immediate impact, is just opportunity cost of the yield. So on A&W, you're getting a 6.1% yield essentially. So as talks about interest rates going up to 6%, up to 7% become more legitimate, that I guess impacts what people need as just a dividend return on A&W to make it worth their while to hold on to the company, hold that risk that a recession doesn't impact them. And the way to get the higher yield for the company is revaluing it at a lower price. So that's my hypothesis. But with that being said, long term, I think starting yield at 6% for a company that's pretty much increased their dividend year over year for the last number of years, barring the exception of the pandemic there, I think is a great buy-in price. So this is one that I know I built a pretty big position over the last year or so in it, down pretty big on it, as you can see, but I'm almost tempted to go back and continue building this one up. The only reason I haven't this last week is just because it's already a pretty big position for me, and that's why I was focusing on some of those other stocks that we were talking about, like Jameson, like Coca-Cola, like SPGI, which are positions that I'm still trying to do my initial build-up on. So hope you guys liked this kind of content. Those were really the main ones that were moving around in my portfolio here. The last one that I can touch on quick is just Northwest. So when they announced their dividend cut, you can kind of see the stock went down on a cliff, down 16%. You know, I never fully understood why a dividend cut, especially one like this that's expected, impacts the stock so much. So down 16% of the company's equity value just because they decided to do what everyone knew was the only thing that made sense to do, which was cut the unsustainable dividend, reinvest that in other areas for the business. So hopefully they can come back stronger. So I get the drop down over time as, you know, people expect the dividend to be cut, as you can kind of see here, from $10 down to $6, $7, $6. But then whenever they make the actual announcement and the dividend gets cut, I just feel like there's a lot of retail investors that maybe overreact or didn't understand that the 12% dividend was obviously going to be getting cut based off the fact that their funds from operation were significantly lower than that dividend payout. And they had additional things coming up, like debt repayments and stuff. So interesting changes to the stock this week. This is one that, with everything else going on in the markets in terms of the great values I see on some of the stocks that I talked about buying and the great moats that they have, and the fact that their fundamentals are solid, they're just being impacted on stock price because of macroeconomic events, sentiment on interest rates. I'm really focused on building out those positions because I fundamentally feel better about them. Northwest looks like, at least at face value, like it's a great value here. Long term, they're going to be or short term, short to medium term, they're expected to do about 80 cents funds from operations, which gets them at about 6.5 times earnings here. Long term, over the next 3-4 years, their CEO said they're trying to get to $1 of FFO per unit, which would be at a 5 times earnings if they're able to execute that. And that's a huge if, given, the lack of credibility that this management team has after the the last year and the stock price and the dividend cut and everything else. But this is just one that has a bit more risk to it to unlock that potential upwards reward. And I just think as I look across my portfolio, there's opportunities to get good returns or reasonable returns that I'd be happy with without taking the same amount of risk and ambiguity around the stock. So I'm not personally adding more to Northwest right now. I'll continue to see how the next few quarters play out. And I'd rather buy the stock at $6 or $7 and feel better about how the company's doing than buying it here at $5 and still not really be sure about how they're going to execute on their next frontier of growth and management of their portfolio. So that's that for this week's update. I hope you guys liked this video. Let me know in the comments if there are any stocks that you want me to be looking at or talking about. Would love to respond back or potentially make a video about it. And hopefully for all of us, next week is a better one in the markets with the last few weeks to month really kicking my butt here. So if you like this kind of content, be sure to give this video a big thumbs up. If you haven't yet, be sure to subscribe to the channel. We do a video like this every week. And then we also do other videos throughout the week on stocks across the Canadian and US market. So if you like that kind of content, be sure to stick around and I'll see you guys in the next one. Thanks.